Fund Supermart, your online gateway to unit trusts.
Malaysia's GDP has been moderating, with the first quarter of 2016 coming in at 4.2% year-on-year growth. Do you think Malaysia will continue to undergo a moderation in GDP growth for the coming few months? What is your outlook for Malaysia's economy for the rest of the year?
In the second half, we are expecting around 4% GDP growth should be achievable. If you see the breakdown of the GDP, it's mainly the three main elements. There is export, net export, investment and consumption. Okay? For export, Malaysia export is quite volatile. We are actually impacted by some of the global uncertainties, the global slowdown, the Europe slowdown, the slowdown in China. Yeah? There are some challenges also at the commodity price. So for the commodity export, impacted by some of the low commodity price, the export number may not look that great. Okay? So that is on the export side. For the investment, we think the investment will still continue to be quite decent because there are more actually projects being farmed out by the government in the second half especially. For consumer sentiment has actually bottomed. If you look at the index that we are monitoring, the consumer sentiment index has actually rebounded slightly. And we see resilience in the consumption of Malaysia being helped by some of the increment to the civil servants and some BRIM farm out, as well as back to normalization after the GST impact. Okay? So that overall will beef up the consumption. So consumption is resilient. So these are the sectors that we quite like. So overall, we are saying that yes, a bit of moderation in GDP, but the 4% is achievable for the whole year.
How much further upside is there for investors, and are valuations still appealing? FBM KLCI Index continued to see earnings downgrade on a year-to-date basis. So with analysts slashing earnings forecast by negative 3.4% and negative 3.9% for 2016 and 2017. What is your take on the earnings outlook?
Okay, for Malaysia, this year we're actually looking at a price-earnings ratio of 17 to 18 times. So for a market in Malaysia, this kind of valuation is quite fair. We're not talking about very stretched valuation or very attractive valuation. It's just fair. Corporate earnings-wise, we have been suffering a decline in corporate earnings since 2 years ago, continuous 3 years for now. And for this year, since early the year, earnings has been quite disappointing. So we have actually seen downgrades after the first quarter number. In the second quarter number, once it's out, we also expect some further downgrade. So for this year, again, we are not very positive on the corporate earnings outlook. We think that there are some downside in the corporate earnings for this year. We could see some marginal decline in corporate earnings for this year.
Do you think small cap segment is a better investment opportunity at this point in time as compared to the big cap segment?
We see opportunities in both big cap and small cap, but we expect more opportunities in the small cap companies. The small cap companies, because of smaller earnings base, at the same time they are mostly in a different niche market. I think their growth opportunities is actually better compared to the big cap. In fact, the big cap are facing a lot of challenges, so it's quite difficult for them to experience a sharp growth from here. So we are actually more positive on the small cap in terms of growth.
Where do you find investment opportunities in Malaysia, and what sectors or teams you have the most and least preference for?
In the Malaysia context, as I mentioned, because consumer sentiment index has actually hit the bottom and started to rebound, we quite like consumption team and the consumer sector, especially those F&B sector, some manufacturing that support this sector and all that. We also like utilities. Utility sector is also giving out quite good dividend. And another sector that we actually like is the manufacturing. Okay? But manufacturing, we are quite selective. There are some manufacturing company, especially the small cap manufacturing company, continue to deliver very good earnings growth, and these are the area that we like. Construction sector, we also like, very selective on some of the construction play, because we believe that there are more orders being farmed out by the government. It will help the overall construction sector. Those sectors that we disfavor for now are mainly commodity driven. Oil and gas sector, we are quite cautious because we see some downside in oil price. So that may actually impact the oil and gas sector, especially the offshore side.
Do you think investors should opt for investments with a dividend investing strategy amid a slowing economy and increasingly volatile markets?
In a very low interest rate environment, especially in some of the countries already have a negative policy rate, like Germany, the 10-year bond has actually gone to negative, Japan likewise. So also other than US, we're talking about possible rate hike. Most of the countries are actually still easing their monetary policy. So in this type of very low interest rate environment, income strategy works very well. Okay. In fact, looking at the Malaysia context, the dividend stocks has already done very well, but we do expect that there are more interest in the income strategy type of funds, as well as the strategy will work for some time. So we continue to like the high dividend yield stocks, and we think that it will work for easily another year.